is going on, my chemical industry family, partners, and friends? Welcome back to the Smart Acid Podcast, where we continue to let borons be borons. Today's show is brought to us by Univar Solutions, which offers the reliability that delivers. No matter if your chemistry grows, flows, or knows, Univar Solutions is the value partner that you need to bring the right product to the right solution at the right time. So go to univarsolutions.com today to find your right solution. This is Andy Erickson, your fabled host of the Smart Acid Podcast, and I'm here with the meringue to my key lime pie. It's the Heartbreaker, Chris Ernst. Heartbreaker, my man, how you holding up?
Andy, I'm fantastic as always. Thank you. I actually have key lime soda water right now from our machine. How about that?
That's rather magical.
Yeah.
Heartbreaker, did you know that we are throwing things into high gear today? And riding shotgun with us is none other than Chris Pickett, a true heavyweight in the freight forecasting and strategy.
I did know.
No, that's good. But before we get with Chris, talk to me, Heartbreaker. Do you know what the origin of riding shotgun comes from?
Wow. No, that's a definite no. I do not know where the origin of riding shotgun.
Well, it's a little U.S. history. Back in the Wild West days, they used to have a shotgun guard that'd ride next to you on the stagecoach, and it was apparently once a vital job. But anyway, that's a little knowledge of us giving back to the people.
I like it. I learn something new every day.
I appreciate that. All right, enough nonsense. As mentioned, we are bringing in Chris Pickett, who is the Chief Commercial Officer at Flock Freight, the largest shared truckload brokerage in the country, helping shippers move freight more efficiently by only paying for the space they use. Before that, Chris spent 14 years at Coyote Logistics, where he helped grow the company from a startup to a $4 billion powerhouse. He has degrees from Virginia Tech, MIT, Georgia Tech, and has a serious passion for decoding freight market cycles. Chris, welcome to the Smart Acid Podcast. How you doing, man?
I'm doing awesome. Thanks for letting me ride a shotgun with you guys today.
No, really appreciate it. That is quite an impressive CV. I mean, Chris and I looked at this and me and the Heartbreaker got a little nervous having you on the show. Don't overstage us.
I think I literally wanted to go to either MIT or Georgia Tech or Virginia Tech, let alone all three.
They are all great schools. So I was trying to hit all the East Coast engineering schools I could.
That's fantastic. All right. Before we get into the real great stuff and talk a little bit about North American freight market, I heard you do a little bit of home brewing.
I do.
All right. So if you're comfortable, we have a little bit of a quiz. We start out all our shows. This is going to be specifically about beer. You think you're willing to play?
Let's give it a shot.
All right. First one, somewhat of a softball. Which ingredient is primarily responsible for the bitterness in beer?
That would be the hops.
All right. 1 for 1.
So far, so good.
A quick 1 for 1, Chris. Excellent. I think I've got another softball for you. We're reasoning into the quiz today. What does IPA stand for in beer terminology, not chemical terminology?
Oh, in beer, that would be India Pale Ale.
There you go. 2 for 2.
Which is one of my specialties.
Oh.
Into low ABV IPAs, aka dad beers. You were kind of early on. You try to get the highest alcohol content you could. As I've gotten a little more mellower, the kind of the art and science is trying to tune into something closer to 2 to 3%, but still get all the flavor profile of a West Coast IPA.
So still get the hoppiness. See,
you got it.
We're talking the same language. This is good. This is going to work out.
It's all chemistry. Perfect.
So you're more of a West Coast IPA guy than an East Coast or a hazy.
Yeah.
Okay. We differ a little bit there, but the ABV is going to be a little stronger on the East Coast. So that makes sense.
Feels like you were just trying to show off a little bit there.
That was good.
Well, a little bit, and I'm thirsty. and our third question is, what is the typical ABV range for a standard IPA?
Oh, for standard IPA, call it 7 to 9%.
Pretty close. According to the quiz, it's 5 to 7. According to the quiz, yeah. You're thinking of DIPAs.
Yeah.
Makes sense. It makes sense.
Excellent. All right. Question 4,
right.
Chris. What U.S. city is often considered the craft beer capital of the country?
The craft beer capital of the country. What U.S. city? There are a bunch of them.
Yep.
Let's go with Portland.
Portland is a great guess, and they would be happy to have you on there. The quiz tells me, Chris, that it's supposed to be San Diego, California.
That's another good one.
It is, but in reading this, I debated that answer. So I'm going out there. I'm a little biased because Chicago does a really well job as well.
They weren't even on the list.
Nah, well, they're not on the answers for the. All right, number 5 and final one. What ancient civilization is believed to have brewed one of the earliest forms of beer? And I can give you some: A, Romans, B, Greeks, C, Sumerians, or D, the Egyptians.
Let's go with the Sumerians.
Yeah.
Bam.
Was that 5 for 5?
Nah, the others were questionable, right? It was Portland versus San Diego, and shot a little high on the ABV for a typical IPA.
Yeah, I think Chris could throw the flag and have the people look at it and make it different to call, because I'm not sure I like the answers to 4.
Let's call it 5 for 5.
There we go. Let's call it 5 for 5. Is what we're getting at.
So we'll get Chris in the office. He'll bring some of the home beer and we'll renegotiate.
You got it.
All right. All right, Chris. Let's get into talking a little bit of shop. It sounds like you spent 25 years in the intersection of supply chain, software, and transportation. What drew you to this space, and what's keeping you here?
So I've become just an uber freight nerd. I mean, so I kind of grew up studying industrial engineering at Virginia Tech. That was my degree coming out. And I think what drew me to industrial engineering was really the nature of complex physical systems, especially as they relate to actually human beings. So in terms of how humans interface with technology and how large industrial systems come to be. And so got super into systems engineering. That led me to kind of an early career in the Bay Area in San Francisco. You're really looking at how to apply technology in novel ways to those industrial systems. During that time, ended up, this is late 90s, right? San Francisco, engineering degree, working for a technology consulting firm. Turns out it wasn't a bad place to find yourself, where every guy or gal that you met up at a bar on the weekends just raised $6 million to sell pet food online. So as the .com revolution, the internet's changed everything. Nothing's going to be the same again. So kind of rode that wave, ended up going over to startup to do exactly that, apply technology in novel ways to support and drive e-commerce fulfillment. Caught a bug for early stage businesses, startups, again, finding kind of like-minded entrepreneurs, individuals to do something different in established technology spaces or industrial spaces, in this case, e-fulfillment, or supply chain fulfillment. As the B2C market bubble inflated, eventually the market proved we didn't need 7 different pet food.coms or diapers.coms or toys.coms. Internet bubble kind of deflated slowly. Then all of a sudden, at that point, got super into novel applications for technology in supply chain management, transportation. It's a very long-winded answer to the question. That led me to graduate school. So went to grad school, first MIT, then Georgia Tech. Met a guy named Jeff Silver at MIT. Jeff was an early founder at a company called Coyote Logistics. So we kept in touch, moved to Chicago to help start Coyote, joined Jeff in that early kind of founding team in 2006. And really what Coyote built was leveraging, again, technology in novel ways to drive efficiencies in truckload transportation. So basically trucking. And so I think every step of the way, it's been, some interplay between technology, physical industries, supply chain management. And I think what has kind of attracted me and what's kept me here is, one, just the sheer size of these markets. I mean, U.S. trucking alone is an $800 billion marketplace. And so just slight improvements in a market that big, can drive huge dividends and allow to build very large businesses over time, which is super interesting. Just the novel applications of technology to do different things in those spaces. And then it's the people. I mean, it's the trucking industry especially is just filled with the most incredible people from all walks of life, the guys and the gals that are driving the trucks, the folks that are manning these warehouses, the folks that are building technology for these spaces, folks that are making purchasing decisions. And so it's, over my career, I've had the chance to work with, super talented, super authentic, hardworking people that, are, making a big difference in, making U.S. transportation more efficient and therefore powering the entire economy. So again, it's the technology, the size of the market, and at the end of the day, it's the people.
Have you ever driven a truck, a rig?
I've not driven a rig.
Okay.
I've ridden in a rig.
Either have I.
That makes 3 of us.
Yeah, I know.
I've ridden shotgun, but they had put behind the wheel.
Did you know the shotgun answer?
I did know that.
Darn it.
I did too, but I had the answer.
He's 6 for 6
Yeah.
now, and I'm 0 for 1.
Yeah.
Okay. All right. Chris, you ready to get into the market then?
Yeah, let's do it.
Yeah, so we'll just jump right in. I mean, what, from your perspective, what's the current state of the over-the-road market right now?
Man, I think in one word, it's exhausted. And so, the U.S. transportation, trucking industry specifically, again, based on kind of my research, background and my observation, it's, runs in a pretty consistent, 3 to 4 year-ish cycle, where because these markets are so large and fragmented, with very low barriers to entry and exit, when market conditions are attractive, meaning spot and contract rates are high, it's easier to make money. That brings new supply to the space, new trucking companies to take advantage of that. Eventually, too much capacity comes in, as quasi-greedy, profit-seeking human beings, operating in a market that runs like this, is we always tend to overdo it. So too much capacity comes in, that upsets the supply-demand balance, takes rates over the falls into the abyss, where there's this eventual reckoning that has to take place, where a lot of that surplus supply is forced to exit, or demand has to pick up. And so, that happened, call it just about 3 years ago. So we had a massive surge in freight demand, during the COVID pandemic, for a bunch of different reasons that we can, get into later. That spiked truckload demand, that spiked truckload rates, that brought new capacity in. Eventually, as I said, too much capacity comes in. The market went deflationary in arguably the second quarter of 2022, and we've been in the reckoning ever since, for lack of a better term. And so spot rates have remained depressed, contract rates have remained depressed, trucking operating costs have not remained compressed, right? So over that period of time, there's also been inflation. Truck tires are more expensive, labor is more expensive, insurance is more expensive, the trucks themselves have gotten more expensive. So it's been a super tough operating environment for asset-based motor carriers, right? No doubt about it. And the entire market's been kind of waiting patiently, or not, the last, call it year and a half, 2 years for that surplus supply to exit, for rates to pick back up, and for market conditions to improve. And so just when we were kind of coming out of the downturn, coming into early 2025, here comes a trade war and a bunch of tariff uncertainty. And that's kind of been just the latest, shoe to drop in terms of creating overhang on the demand side that I would argue has kept market rates depressed, probably longer than they should be. And so I think, if one word to describe the market, it's exhausted, but certainly, based on past cycles, it certainly looks like, there is a great chance for rates and operating conditions to improve going into the back half of 25.
Chris, is there one surprising data point that you're watching?
Yeah, I guess the biggest surprise to me over the last, you call it year or so, or even you call it the entire kind of post-COVID kind of correction, is just the resiliency of the U.S. consumer. And so again, the story of the trucking market is one of supply and demand. So what drives demand? Ultimately, it's, for the most part, it's U.S. industrial production. So the rate at which we're making stuff in the U.S., either for domestic consumption or export, the vast majority of it drives domestic consumption. So as long as you and I, and we're all consuming things, buying things, physical goods, then that requires the U.S. industrial plants and factories to make those goods for our consumption. And ultimately, that requires a lot of truckload transportation to move those goods in between. So as long as consumption is healthy, as long as retail sales are healthy and at least stable, then that tends to be a pretty bullish signal for the demand side of the trucking marketplace. And so, despite all of the headwinds over the last, call it 2 years, spiking inflation, high interest rates, resumption of student loan payments, tightening of credit markets, volatility in the labor markets, there's been forecasts of the consumer falling off a cliff, at least slowing down, just about every quarter for the last 2 years, and it really hasn't happened yet. Even with the most recent, tariff concerns around, driving inflation and that, putting a lid on labor markets, all these things may come to be, but it hasn't happened yet. And so, in terms of building my at least position or level of optimism for the U.S. economy going forward, and then the U.S. trucking industry that supports it, the most important indicator I look at is consumption. And the surprise to me has been consumption has held up the way that it has. It's been stable to slightly pushing up into the right. What has been a surprise on top of that is the lack of reaction with industrial production. And so we talked about we need to build the things to drive consumption. We've seen pretty solid consumption numbers, but we haven't seen the rise in industrial production to support it so far. Whether that means consumption patterns are changing, or there's been enough inventory out there for that to support these levels of consumption. We just started to see a rise in industrial production Q1 of this year in a way that we haven't seen the last 8 or 9 quarters. The question going forward is, will that persist, with this new headwind around, tariff uncertainty? Although we are getting kind of at least more positive news almost every day now, including today. Until there's more certainty, more clarity on U.S. trade policy, it's really hard for U.S. supply chains to make investment decisions, to decide what they want to do with production, what they want to do with sourcing, until they have a better sense of what those duties are going to cost. And so I think as we get hopefully to the end of this trade war and we get a little more clarity, I think you'll see a lot of supply chains starting to turn back on the investment, either in domestic production or just kind of ramping up orders in a way that they couldn't, when they had no idea what they'd pay for goods imported from China once they landed. So it's really kind of those two indicators: consumption and then industrial production. And I would say I've been surprised to the upside with consumption, and I guess a little bit surprised to the downside with industrial activity.
Thank you.
I almost want to dig into, do you know when this trade war is going to end? But that's a very unfair question. So we won't go there. How do companies use this data to stay ahead of the market as it shifts?
If you spent more than probably 5 minutes in the transportation industry, the idea that the industry runs in cycles is not a new concept. And so I think even when I came in the industry, a decade or so ago, people would tell me, hey, sometimes trucking rates are high, and the carriers kind of have the upper hand in terms of negotiating rates, and sometimes trucking rates are low, and procurement teams and shippers kind of have the upper hand in terms of driving rates down. But no one could ever tell me where we were in that cycle. And so I think part of kind of what I learned and observed, during the days of scaling Coyote was that, depending on how you looked at the data, in this case, year over year, truckload line haul rates, you could actually see a pretty pronounced and pretty consistent cyclical pattern around exactly what it described. Rates are high, supply comes in, too much supply comes in, drives rates down. Almost kind of looks like a sine curve, if you remember your kind of high school trig. And it's continued in this kind of 3 to 4 year pattern, at least since I've been paying attention the last 15 or 20 years. And so my perspective has been, if by definition we operate in a cycle, and if you have a sense of where we are in the cycle, you could at least make better long-term decisions to better understand where we're headed directionally. And so the market doesn't move in a kind of a random walk pattern. For sure, there are plenty of variables and plenty of things that drive the market up or down. They'll all conspire to have an impact on short-term rates. But long-term, the market's been pretty consistent, plus or minus a few quarters. And so, what I tend to kind of advise shippers or carriers or kind of intermediaries is, take these kind of long-term patterns, kind of augment your existing data with some of this external data. At the very least, it'll help you make sense of kind of what you're experiencing in terms of your own market activity. And at the very best, can help inform kind of long-term direction. And if you've got conviction around long-term direction, you can more confidently make investment decisions. And so, all that said, also keep in mind that past performance, so that today doesn't always guarantee future results. And so, while the patterns are consistent, timing can be tricky. And so, make sure you're hedging or making your investment decisions commensurately with how confident you are on what's coming next market-wise.
Chris, you hinted at this a little bit in your last answer, but maybe build on it as to what piece of advice you would give to logistics professionals heading into the back half of the year here.
Hang in there. The one thing, is whether the market's up or down, it's people experience it in different ways, and I love the phrase this too shall pass, and this too shall pass. We talked about this pretty painful extended freight recession. So if you're on the supply side, it hasn't felt great. Right, because it's been harder to make money and flat out survive if you're not covering your operating costs. But this too shall pass. The structure of the market, from my perspective, has changed. So as long as that's the case, there should be a case for rising spot and contract rates over the next call it 12 to 24 months. What we don't know is the timing and the magnitude. And so if you're on the supply side, hang in there, continue to drive out operating cost if you can. If you're on the demand side, if you're buying, right, your trucking costs have been pretty low, the last 3 years. During COVID, that wasn't the case. So things have balanced out. And so, if you're planning for the back half of 2025 going into 2026, and you're on the demand side, expect that the cost of transportation, truckload transportation, to go up. And the best way to prepare yourself is to take advantage of the time we have at this kind of temporary level of equilibrium to reevaluate, who you're working with, long-term partners, different modes you are leveraging to move your freight, and be prepared for a period where, market rates could be, 15, 20, 25% higher within the next 12 months.
So talk to us a little bit. We found some stuff on the picket line. Can you talk to our listeners a little bit about what the picket line is and your market research there?
Yeah, so the Picket Line is a monthly kind of research publication I put out. There's really kind of the accumulation of a methodology or framework that I developed during my days at Coyote. You're really trying to understand the direction of trucking markets. Oftentimes, if you operate as a freight broker or a non-asset-based intermediary like Coyote and Flock and a bunch of others, ultimately you don't own the trucks or employ the drivers. And oftentimes you're making long-term rate commitments to shippers that buy in the contract market without really knowing what you're going to spend on that capacity when it comes time to move the freight. So in a lot of ways, you're selling contract and then you're buying spot when it comes time to fulfill that obligation. And so, trying to predict trucking rates over a 1-year period, which is oftentimes how long you're committing, if you're on the supply side, that can be dangerous. That can be pretty tricky. And so if you're wrong in terms of, the market gets hotter faster than you expected, you get a squeeze margin wise and you've got to make some tough decisions. If you're predicting a more inflationary market than your competitors, then you're not competitive and you don't win the freight. And so there's a lot of value in just being directionally correct on the path of spot and contract rates. And so ultimately, develop the methodology to try to get better at that, so we can make better long-term commitments, be a better service provider throughout the course of those contracts. And that resulted in effectively this way of looking at the market, again, mapping truckload line haul rates on a year-over-year basis. When you look at them on a year-over-year basis, you ultimately get this thing that looks like a sine curve. And so originally, we kind of dubbed it the Pickett curve. And then once it proved directionally consistent, it was rebranded as the Coyote curve. We started talking about it publicly because it looked like literally a curve. When I left Coyote at the end of 2020, the trademark was there as obviously I couldn't call it the Coyote curve, but the methodology remained. I had different data points that I would pull in, and so kind of stepping back and looking at the actual pattern, it looked like it's still a curve-ish, but it's effectively a series of connected lines. Looks a little spiky, so ended up dubbing it the Picket Line. And so again, every month I lock myself up in the attic and look at it, a couple dozen different macro indicators. Try to get a sense of what the tea leaves are showing, relative to past patterns, and that ends up in the 45 to 50 page document that tries to summarize all these market indicators and make an informed prediction on what comes next. So it's out there every month. It includes a forecast for the trucking markets, and it kind of includes all the macro indicators that I kind of look at to help get an understanding of what's happening with supply and demand, and whether those data points all support this narrative of a perpetuating cycle.
Chris, 2 questions for you. First, I'm interested as to how long you spend in the attic every month to create the 40 or 50 pages.
Like in time, you want like how many IPAs?
That's right.
I think I've got it down to a pretty consistent format now. It's kind of the course of 3 days, but still probably a good 8 to 10 hours. It's possible someday LLMs and can run that thing through ChatGPT or and spit out something comparable, but we're not there yet. So it's still a good 8 to 10 hours of updating charts and synthesizing it all, and ends up again with a 45-page book.
No, that's awesome. Your attic must be nicer than mine.
No, or maybe not. Maybe it'd be 20 hours if it was.
Chris, where and or how would our listeners find the Picket Line if they wanted to?
Yes, you can go to www.picketresearch.com. So we publish, we're going on 5, this is the 5th year. So we've got excerpts we'll publish actually on the website kind of each month. Then you can also go to the Pickett Research LinkedIn page, where we also kind of publish the excerpts there.
We always like to ask our guests at the end, kind of as a wrap up. What is one takeaway you'd like our listeners to have from this conversation? So
again, the market is cyclical. Doesn't mean it's good or it's bad. Just a function of the market in which we operate in. And I think the folks that have tended to fare the best through the cycles tend to have a long-term kind of planning horizon. The idea is not to go, peak to trough and try to engineer out the absolute lowest rates or the absolute highest rates. It's the folks that engage with strategic long-term partners, finds the folks that they want to do business with over years, not quarters. Build optionality and flexibility. Invest in removing waste. So getting more efficient removing waste never goes out of style. That's an all-weather strategy. Things like don't pay for capacity you don't use, which is ultimately what we're building at Flock, where you're getting truckload service, which means same truck, same driver, no terminal consolidation. But contrary to just about anyone else out there, you're only paying for the space you're using. So effectively, it's ride sharing for freight. You're not compromising on service levels, not paying for space you don't use. And so, why that matters for a shipper, especially in a volatile freight environment, is you're buying velocity. You're keeping your freight moving. So if you have half a truckload of stuff, right, because your order sizes have gotten smaller because either we're going through a downturn or because your own supply chains have gotten more volatile. If you have half a truckload to move, without Flock, you're going to ship that with the truckload carrier and you're going to pay a full truckload rate. Or you're going to let that freight sit in inventory until more freight shows up enough to fill the truck and then ship it. So either way, you're either paying to ship air or freight is sitting. And what we're trying to create is an option for shippers to keep their freight moving. Don't pay for freight you don't need. Save money, move faster, gets touched less, gets damaged less, and effectively maximizing the absolute total yield of that capacity. We've got tons of data that suggest the U.S. truckload market, despite all of the perpetual driver shortage and wear and tear on U.S. infrastructure and all the congestion challenges that came to light during COVID, 30 to 35% of that capacity is wasted because exactly what I've talked about. And so you think about it, it's 1 out of every 3 trucks on the road is effectively running empty because there is no platform for shippers to pool their freight together to maximize that capacity. So if there is a way to unlock that, shippers get the benefit, carriers get the benefit, because now you can come and you recognize the maximum revenue yield of that trailer, right? So if there's air shipping, right, there's more revenue that carrier could be making if they put freight in the back of that. So what Flock is trying to do is you really attack that underutilized truckload opportunity and create a way for, again, shippers to save money, move freight faster, ways for carriers to make more money, and ultimately drive more efficiency across the U.S. trucking industry. And so looking at kind of ideas like that, through the cycle, it's this too shall pass, and as long as you've got the right partners and the right time horizon, and are looking at things for the long term, then there's nothing scary about the cycle.
That's interesting because I think there'd be a cool twist on a sustainability twist there as well, right? If you're not moving air, you're moving more product, you're moving less. It's just part of it. I don't know.
For sure, exactly. You're filling up, you're saving money, and it's 20 to 40% less carbon emitted, right? Because again, you're not using those miles to needlessly ship that air. So it's a win-win-win. Super hard to do from a math and a combinatorial standpoint, but I think it's a great opportunity for the market again to build flexibility, to build efficiency, and to help everyone again save the wear and tear on the environment as well.
Chris, really appreciate you joining, and thanks for the time.
Yeah, but again, at the end of the day, it's trucking, right? So it's moving stuff from point A to point B. Who doesn't love planes, trains, automobiles, and trucks, and the hardworking American men and women that drive this industry. So I think it's been a true pleasure and an honor to be able to try to contribute to doing exactly that. Make it a more fulfilling place for both the supply side and the sell side, and do what we can to again move the industry forward innovation wise.
Okay, chemical industry family, partners, and friends. That's a wrap on another episode of the Smart Acids podcast, brought to you by Univar Solutions. Thank you to our guest, Chris Pickett. As always, really great stuff and a ton of knowledge there that's above my pay grade from a knowledge perspective, so appreciate his time. Thanks, as always, to our loyal listeners. Thanks to my storied Smart Acids co-host,
Fabled. It was fabled this time.
It's fabled this time. Thanks to everybody behind the curtain who makes this all possible, for sure. Everybody, as a reminder, you can find us wherever you get your podcast, Apple Podcasts, Spotify, and we have a YouTube channel. Please look us up at any or all of those locations. Until next time, everybody, stay safe, stay healthy. See everybody again soon.